In September 2007, British television showed something that financial historians had written off as a relic of the 19th century: ordinary people standing in long queues outside a bank, waiting to get their money out before it was too late. Northern Rock had not made the kind of obviously reckless loans that would define later crisis stories. Its problem was structural, buried in the funding model that had powered its growth. Understanding why that model failed and how fast it unraveled changes how you think about what makes any bank safe. On the morning of Friday, September 14th, 2007, customers began lining up outside Northern Rock branches across the United Kingdom before the doors opened. They were not protesting. They were scared. By midday, queues stretched around the block in several cities. Television cameras arrived. By evening, images of ordinary British savers waiting to withdraw their money had been broadcast around the world. The Bank of England had not seen anything like it since the collapse of Over Gurney and Company in 1866, 141 years earlier. The images were so unexpected that many commentators reached for a word that almost no living person had applied to Britain: bank run. Northern Rock began as a building society in Newcastle upon Tyne, formed in 1965 from the merger of two older mutual institutions: Northern Counties Permanent Building Society, which dated to 1850, and Rock Building Society, which dated to 1865. Building societies were mutual organizations. Depositors were members, there were no outside shareholders, and lending was straightforwardly funded by savings. In October 1997, as British financial deregulation made it possible, Northern Rock demutualized and listed on the London Stock Exchange. Over the following decade, it grew aggressively. By 2007, it had become, by many accounts, the fifth largest mortgage lender in the United Kingdom by new lending, with total assets that had grown to roughly £113 billion. Watch the full breakdown on Wealthwright.